Exactly what happened. John A.G. here. With less than half an hour left before the weekly close, silver got slammed hard, bounced harder, and then stalled right on the line the big banks did not want you to see, $90. They shoved it down to the mid-86s earlier, they tried to pin it under 90 into the close, and yet buyers kept dragging it right back up. That tug of war is not normal volatility. It's a battle for a psychological level, a headline level, and, if you understand the mechanics, a leverage level. And here's the part that should make you sit up. While that fight was happening, the paper market printed volume numbers that dwarf real-world metal. We're talking about ounces being traded that the planet can't even produce in a year, in a market where physical supply is already tight. That mismatch is the story. The rest is theater. Now, quick favor before we go deeper. My YouTube stats show a big chunk of you watch every week, and still haven't subscribed. If you actually value this kind of straight, no-fluff breakdown, hit subscribe right now and drop OG John AG in the comments so I can see who's really riding with me. Also, if you want daily posts, instant updates, quick voice notes, and my personal take that I don't always put on YouTube, I've made a WhatsApp channel for the community. The link is in the description. Join it, because that's where the fast stuff goes first. All right, back to the chaos. Silver didn't just move, it got punched. The kind of punch you only see when major options and major positioning are on the table. Price was shoved down into the high 86s, then crawled, then sprinted back toward $90. Gold had its own drama, dropping sharply and then fighting back toward the $4,600 zone. And the timing matters. This wasn't midweek randomness. This was into the close, into key levels, with the clock running out. Why would anyone care that much about the last minutes? Because weekly closes shape headlines, they shape chart signals, they shape margin calls, and they shape what a lot of funds, algorithms, and risk desks are forced to do next. If silver closes above $90, it sends a message. The dip got bought, the sellers couldn't hold it, and the next push is on the table. If it closes below, the media gets to run the same tired script. Silver failed, silver rejected, speculation cooled, and on and on. That messaging is not accidental. It's part of the game. Now let's talk about the game with real numbers. When I say a billion paper ounces, I'm not using a dramatic metaphor. I'm talking about the way futures contracts translate into metal. One standard silver futures contract represents 5,000 ounces. So when you see a day with, say, 250,000 contracts changing hands, that's 250,000 multiplied by 5,000. Do the math, and you're staring at roughly 1.25 billion ounces on the tape. And here's the punchline. The world doesn't mine a billion ounces of silver in a year. Not even close. So if the paper market can print annual supply in a single session, you're dealing with a market where the tail can wag the dog. That's why you can have days that feel irrational. It's also why the banker slam can happen fast. A wave of contracts hits, stops get triggered, momentum traders pile in, and then, once the objective is achieved, the same machinery can reverse it. If you're new here, don't get lost in the jargon. Just remember this. In highly leveraged markets, price is often a negotiation between paper positioning and physical reality, not a simple reflection of how many coins someone bought at lunch. Now I want to rewind the timeline for a second so you can feel the sequence. Going into the session, silver was already on edge after recent highs. Then, during the day, it got shoved down aggressively, into the high 86s. That was the shock. Right after that, you saw the crawlback, 87, 88, 89, and then the magnet, 90. With about 20 to 25 minutes left, it was hovering just under $90, moving in tiny increments like it was walking a tightrope. 8 cents under, 12 cents under, 2 cents under. A quick poke above, then back below. That's the kind of microdrama most people ignore, but it's exactly where the big money cares. Because every one of those pennies decides whether a pile of options dies or lives, whether a chart prints breakout or failure, and whether next week opens with confidence or doubt. And while silver was doing that, gold was running its own obstacle course. It dropped hard toward the mid-4500s and then snapped back, testing the upper 4500s again. If you've ever wondered why metals traders watch gold and silver together, that's why. When both recover after a hit, it tells you the pressure isn't isolated. So yes, the clock mattered. The close mattered. The level mattered. Earlier in the week, the paper market pushed through contract counts that translate into over a billion paper ounces traded in a single day. Let that sink in. A billion. 2 days in a row, we're in that neighborhood. Meanwhile, annual global mine supply is a fraction of that. Even if you don't know the exact figures, your instinct should scream, this is leverage stacked on leverage stacked on leverage. When you see that, you're not watching a simple supply and demand auction. You're watching a financial instrument being used like a steering wheel. And that's why the last day of certain events becomes a magnet for manipulation attempts. There were two big calendar reasons the push-pull intensified. First, options. When options expire, the incentive to pin price to the most profitable strike for the big players goes through the roof. If price finishes just under a level, a mountain of calls expires worthless. If it finishes just above, the opposite happens. It's not conspiracy, it's incentives. And in markets where paper volume can flood the tape, incentives can look a lot like sudden price action. Second, rebalancing. Every year you'll hear the same storyline. Some index will rebalance, therefore metals must crash. It's the perfect scare tactic because it sounds technical, it sounds official, and it gives people a reason to panic sell without understanding the actual scale and timing. Most of the time, the reality is smaller and shorter than the fear narrative. And here's the clue that fear was overcooked. Despite all the talk of a massive crash, silver didn't implode. It fought. It dipped, then it reclaimed. That's not what a market top looks like. That's what a contested breakout looks like. Now, if you're feeling frustrated because we should have been higher, zoom out for 2 seconds. Just days ago, $90 was essentially an all-time area again. Markets don't usually teleport from a breakout to a smooth straight line. They fight, they retest, they shake out leverage, and then, if the underlying pressure is real, they continue. But I promised you a moment that should make you pay attention. Here it is. During this exact period of high tension, the U.S. Mint's pricing on Silver Eagles showed numbers that are, frankly, outrageous compared to spot. Proof coins priced around the $170 range, uncirculated around the high 160s. That number didn't come from a rumor. It popped up while people were watching the close and comparing notes. Someone flagged it, others checked it, and suddenly the chat wasn't talking about charts anymore. Everyone was asking the same thing. Why would an official outlet price a 1-ounce silver product like this? And notice what it does to perception. If a new viewer hears silver is around 90, they think, okay, expensive, but maybe manageable. Then they see a government product listed at nearly double that, and their brain does the math. Either premiums are going insane, or spot is not telling the full story, or both. This is where you have to think like a risk manager. If you're a mint or a large dealer, you don't care about today's spot as much as you care about replacement cost. If you sell a product today and you can't replace it next week without paying more, you either stop selling, ration supply, or jack the price high enough to protect yourself. That's basic inventory defense. So those numbers are not a prediction. They're a stress signal. Now zoom out and connect it to the close battle. When the paper market tries to pin price below $90, while retail channels flash prices implying much higher replacement risk, it creates a credibility gap. And credibility gaps get resolved in one of two ways. Either physical loosens and premiums collapse, or paper price rises to reduce the pressure. Sometimes you get a messy mixture. But gaps don't stay wide forever. And because this was happening right as options expired and rebalancing headlines were peaking, it also exposed something about the media cycle. The fear headline machine wants you to believe every dip is the start of a crash. But in a real crash, you don't see immediate snapbacks and tightening physical signals at the same time. In a real crash, premiums often collapse because nobody wants the product. Here, people still want the product. That's the difference. Now let's keep it practical. If you're sitting at home, you might be thinking, okay, but what should I actually do with that information? First, don't confuse collectible pricing with raw metal value. A proof coin is not a generic bar. But also, don't ignore the direction of official premiums. Direction matters. Second, compare 3 prices, not 1. Compare paper spot, local shop buy-sell spreads, and online or official product pricing. When those 3 diverge, it's telling you the market is under strain. Third, if you're buying, decide what you're buying for. If it's long-term metal exposure, don't let a single day's candle bully you. If it's short-term trading, manage risk tighter than you think you need to, because these swings are designed to punish leverage. And I'll add one more. Watch liquidity. When dealers say, volume is crazy, that sounds like good news, but it also means their cash is tied up. A shop can sell a lot and still feel squeezed if replacement stock is expensive and buyers are coming in nonstop. That's when you start hearing things like, we'll buy, but at a bigger discount, or we're not taking that category today, or we're limiting certain items. It's not because they hate customers, it's because they're defending their balance sheet. So, if you see weird buyback offers, like paying noticeably under spot for perfectly fine silver, that can be a symptom of liquidity strain, not a signal that silver is suddenly worthless. The spread is the stress gauge. Regardless of what you think about premiums, collectibles, or government pricing, this tells you something important. The retail product pipeline is either under stress, or the issuer is protecting itself against what it believes may come next. And no, you don't have to believe that the mint predicts the future to understand what it signals. When official channels jack prices that far above spot, it means one of two things. Either demand is ripping through their allocation, or their costs and replacement risk have changed, or both. In any case, it's not a sign of an easy, comfortable market. So here's the question. If paper price is flirting with $90, why are official products signaling $160 to $170? That gap is the tension point. Paper can be pushed around. Physical has to be sourced, minted, shipped, insured, and replaced. When those two worlds diverge, it's a warning light. And it wasn't just one government site. People walking into local coin shops reported premiums widening. Generic rounds and bars a few dollars over spot, but eagles and other high-demand items at much higher premiums. Some dealers, by their own reports, were even hesitant about taking certain categories of lower purity silver because refiners tighten standards when throughput gets jammed. Does that mean no silver exists? No. It means inventory is moving fast, cash flow gets strained, and replacement becomes harder at the speed the market is demanding. Now, the mainstream framing you'll hear is always the same. If the price is rising, it's a bubble. But they never ask the obvious question. What if the price is rising because the price was wrong? In other words, what if this isn't a mania? What if it's price discovery catching up to reality? Because when you have a market that trades more on paper than can be delivered, you can hold the lid on for a while. But when physical demand stays persistent, the cost of holding the lid gets higher. And eventually the lid doesn't pop politely, it pops violently. This is why the phrase you keep hearing, backwardation, matters. It's a nerdy word, but the meaning is simple. People are willing to pay more now than later, because now is scarce. When that shows up, it's a signal that immediate metal is valued more than a promise. And when the market finishes in backwardation, even slightly, it's like the physical market whispering, your paper price is cute, let's see if you can source the real thing. Now, I'm not here to sell you fear. I'm here to translate what the tape is saying. So let's break down the key signals from this episode and what I'll be watching next. Signal 1, the defense of $90. A price level becomes real when it gets tested and defended. Not once, repeatedly. The entire week you could see attempts to shove silver away from $90, and yet it kept crawling back. That's not a guarantee of anything, but it's a sign that buyers are not satisfied with the price they're being offered. Signal 2, the absurd paper volume. When you see day after day with paper ounces that rival annual production, you're seeing the scale of leverage that can cause sudden spikes and sudden dips. That's why you can't read these markets like a simple farmer's market. The leverage is the amplifier. Signal 3, the retail and official premium response. The U.S. mint price tags didn't happen in a vacuum. Local premiums didn't widen because everyone is relaxed. Premiums widen when replacement feels uncertain. Signal 4, vault movement. Whenever meaningful amounts are withdrawn from vault systems tied to delivery, it tightens the float. And when the float tightens in a market where paper claims are huge, the system becomes more fragile. You don't need to know every detail to understand the basic physics. Less available metal plus more claims equals more stress. Now let me hit you with a cliffhanger that a lot of people will miss. The weekend close is not the end of the story. The next story is what happens when the U.S. market is quieter and the Asian market trades. Because while some Western markets pause, other exchanges stay active. And when price discovery happens outside the most controlled arena, you sometimes see the gap effect on reopen. Prices jump because the market reprices when the lid isn't being sat on as hard. Here's why. Even when one big venue pauses for a holiday or a weekend window, other venues don't politely stop caring. The Asian session can trade, regional futures can price, and physical dealers can keep quoting. So the close is sometimes just the end of one arena, not the end of the fight. And in this particular episode, overseas pricing was already flashing strength. One major regional market was marking silver up near the high 90s, while the Western paper market was still wrestling with the $90 handle. That is exactly the kind of divergence that makes reopenings spicy. Because when one venue reopens after being closed, it doesn't reopen in a vacuum. It reopens into the world as it is, not the world as it was. That's how you get the gap behavior traders talk about. And while we're here, let's talk about another dashboard gauge that quietly screamed, something is changing, the gold to silver ratio. When that ratio drops toward the low 50s, it means silver is outperforming gold. It's not a magic number, but it's a meaningful compression compared to the high ratios people got used to. Now combine that with the vault chatter. You'll see periodic reports of millions of ounces leaving vault systems tied to deliverable supply. When registered or deliverable categories shrink, it matters more than most people realize, because it's the portion that can actually be tapped for settlement. When that portion declines sharply over months, the system gets tighter, and every surge in demand becomes more consequential. So here's the setup going into the next major delivery window. Elevated price, huge paper volume, tightening deliverable float, and a community that's watching every close like a hawk. That combination is why I keep saying the next move won't be polite. It might not be tomorrow, it might not be in a straight line, but pressure systems don't release gently when you keep compressing them. Now, one more detail people overlook. When big exchanges are closed, the suppressor role people assign to them can't operate the same way. That doesn't mean price will only rise. It means a different group of participants gets a louder voice for a few hours. Sometimes that produces a breakout. Sometimes it produces a fake out. Either way, it produces information. That's why I'll be tracking the next open closely. And if you want those instant updates, again, the WhatsApp channel is the quickest way to get them. If you've ever looked at a chart and seen a gap, a jump where the bars don't connect, that often shows up after closures when new information or new pressure hits while a venue is shut. In calm markets, gaps tend to get filled. In stress markets, gaps can be the start of a move, not the end of one. So if silver held near $90 into the close, and if overseas pricing stays elevated, the question becomes, does the next reopen force a higher starting point? Now, I want to address the most common viewer question that comes up during a moment like this. Should I wait for a dip? Here's the honest answer. If you're trying to nail the perfect bottom, you're competing against entities that can move the paper price with size, speed, and leverage. Waiting for a dip can work, but it can also turn into watching the train leave the station while you stand on the platform holding your ticket. The strategy that consistently beats emotional timing is simple: consistency. If you're accumulating long-term, you dollar cost average. You pick a schedule and you stick to it. And when the market gives you a real dip, an actual hard flush, you lean in more. That's how you avoid the psychological trap where you never buy because the perfect dip never arrives. Now, there's another angle here that matters for retention and for reality. This market is not just about spot price. It's about premiums, availability, and liquidity. If you wait for spot to drop $2 but premiums widen $5, did you really win the dip? That's why people who only stare at a chart can miss what's happening at the dealer level. So here's my first question for you. When you check your local market, are premiums getting wider or tighter where you live right now? Drop your city or country and your premium range in the comments. Let's compare notes. Now right here is where I need to weave in something that matters to the channel and to the movement. You've probably noticed the internet is full of copy-paste channels recycling the same clips, the same talking points, and the same thumbnails. I'm running a campaign to push back against that. If you want original work to survive, support the campaign by subscribing and commenting OG John AG under this video. It's a small action that tells the algorithm, original beats copycats. All right, now let's talk about the banker slam itself, because that phrase gets thrown around and I want you to understand what it looks like mechanically. A slam is usually a rapid, aggressive push in a thin or sensitive moment, often around open, around close, around a data release, or around an options window. It's not always illegal. Sometimes it's simply large players exploiting the structure. But it does create the same effect. It scares weak hands, triggers stops, and creates liquidity for the buyer or the short coverer. That's why you saw price shove down sharply into the $86 area, then rebound. It shakes out the people who panic. It collects their sell orders. And then, once the selling is exhausted, the price can be allowed to drift back up because the objective was never fair price. The objective was positioning. Now, here's another cliffhanger. The slam itself can be bullish. I know that sounds backward, but think about it. If a market needs a violent slam to suppress it under a level, that means the natural drift is higher. If sellers were truly in control, they wouldn't need to show you their teeth. They could just let the market fall. But when it keeps snapping back, it's a signal that demand is still there. That doesn't mean straight up. It means the path is going to be volatile. It means fake outs. It means head fakes. It means emotional traps. And that's why your mindset has to be different in a leverage-dominated market. Now, I promised you a clean structure, so we're going to connect the dots with gold for a minute, because gold's behavior often tells you whether the move is speculation or monetary stress. Gold dipped, got smacked, and then recovered toward a major round number area. When gold and silver both fight back after a slam, it suggests broader buying pressure rather than a single metal gimmick. And when the gold to silver ratio drops toward the low 50s, it's a sign silver is outperforming. That ratio can swing wildly, but when it compresses, it often means silver is in the driver's seat. If you're the type who plays ratio trades, switching from gold to silver or vice versa, this is where you pay attention. But even if you never do a trade, the ratio is like a dashboard gauge. It tells you which metal is pulling harder. Now here's my second question for you, and I want real answers in the comments. If the ratio keeps dropping, Would you swap any gold for silver, or are you staying put? Explain why, because your reasoning will help other viewers who are trying to learn. Now, before we go to the what comes next section, I need to deliver a quick creative shout out. If you want to hear real silver success stories, people who timed entries well, people who built stacks patiently, people who turned discipline into wins, there's a link in the description to another channel that focuses on nothing but those stories. Subscribe over there too, because motivation and strategy from real people can be the difference between quitting early and finishing strong. All right, next, what to watch after this close. 1. Watch whether $90 becomes a floor or stays a ceiling. The market just told you it cares. If it holds above, watch for buyers to treat dips toward $90 as opportunities. If it falls below, watch whether it snaps back quickly. The speed of the snapback is the clue. 2. Watch the overseas pricing. If overseas markets hold higher pricing while one venue is shut, reopens can gap. And gaps can trigger momentum buying because risk desks and algorithms react to the new range. 3. Watch the physical premiums. If spot chops sideways but premiums stay elevated, it means the tightness is underneath. If premiums compress, it may mean supply is catching up, temporarily. 4. Watch the vault flows and delivery pressure. Big withdrawals during non-delivery months are a loud signal, and if the next major delivery window approaches with a tight float, the stress can increase. Now, I'm going to give you a behind-the-scenes access point. By the time you're watching this, there's already a members-only video posted that wraps all the updates into one place, with extra details and my deeper analysis. If you want that, and you want to support the channel directly, join membership. It also makes it obvious who's truly following the work, because members are the ones who keep the lights on when the algorithm gets weird. And remember, the membership content goes deeper. Not longer just to be longer, deeper. More context, more connections, less noise. Now let's do a quick mini Q&A style section, because I know what you're thinking. What if the banks just slam it again? They might. And if they do, the question is whether the slam holds. A slam that fails and reverses is fuel. A slam that holds and drags price into a multi-day slide is a different environment. You don't predict it with vibes, you watch the behavior. Is this retail FOMO? Not yet. When real FOMO hits, you'll feel it. You'll see it on mainstream headlines daily. You'll hear coworkers asking about silver. You'll see your family texting you about that metal thing. We're not there. This looks more like early adoption pressure plus institutional positioning plus a physical pipeline that's getting tested. Should I only buy the cheapest stuff? Cheap is good, but value is better. If you can get higher premium items near generic pricing, that can be smarter because when the dust settles, premium can expand again. The key is not to overpay out of panic. If you don't know your local premium landscape, you're vulnerable. Learn it. Now, a small but important community request. If any of you watching are doing well, business, career, investing, life, share a quick success story in the comments. I'm serious. 1 or 2 lines is enough. It keeps the community's morale up, and it reminds people that disciplined moves pay off. And yes, if you've had wins in metals, share that too. If you've had lessons, share those. We're building a stronger crowd here, not just chasing a chart. Now, let's zoom back to that mint pricing one more time, because it's too loud to ignore. When you see retail products listed at premiums that are basically, "Are you kidding me?" numbers, it can do 2 things psychologically. It can scare you into thinking you missed it, or it can wake you up to the idea that spot price is not the only price that exists. If your local shop is selling Eagles $10 over spot while spot is $90, that's one world. If official products are implying $170, that's another world. The truth is probably in the tension between those worlds, and the direction of travel matters more than the exact number. Now, I want to address something else people keep bringing up: paper versus physical. Here's the simplest way I can say it. Paper price is the scoreboard. Physical is the game. Scoreboards can glitch. Games are real. If you're trading short-term, you live by the scoreboard, because that's your arena. If you're stacking long-term, you care about the game. Supply, demand, industrial usage, replacement risk, and whether people are willing to take delivery. That's why the billion-ounce days matter. They show you how wild the scoreboard has become. But they also show you how quickly the scoreboard can be forced to adjust when reality pushes back. Now, let's talk about the next catalyst people are sleeping on. When markets have long weekends, closures, or thin liquidity windows, price can move sharply because fewer participants can respond. That can create either a nasty slam or a sudden rip, and it's why you should be careful with leverage and careful with emotional decisions. The market loves to punish impatience. So here's what I'm watching on the next open. Do we see a quick dip to scare people, or do we see a gap up that forces late buyers to chase? because either outcome creates a story. And the story is what drives the next wave of attention. And attention is what creates virality. If silver convincingly holds $90 and starts pressing higher, the silver is dead narrative breaks. If the ratio keeps compressing, silver becomes the headline. If official products keep showing extreme premiums, people start asking questions. And once questions start, you get new eyes. That's why your job, as a viewer, is to stay calm and stay informed. Panic is expensive. Discipline is profitable. Now, let's tighten this into actionable takeaways because I don't want you leaving with just adrenaline. Takeaway 1. The $90 level is the current battleground. Watch it. Takeaway 2. Don't let rebalancing headlines push you into emotional decisions. Those stories come every year. The market doesn't care about your fear, it cares about positioning. Takeaway 3. Watch the physical premiums where you live. It's the real-time health gauge. Takeaway 4. If you want daily updates, the WhatsApp channel is the fastest lane. Join it from the description because I post there when things move quickly. Takeaway 5. If you want the full recap in one place, the members-only video is already live by the time you're watching this. Now, I'll end with this. The bankers tried to slam it. They tried to scare you. They tried to pin it. And yet, silver fought back to the line that matters. That doesn't guarantee tomorrow, but it tells you one thing clearly. The story is not over. Before I wrap, I want to give you the if I'm wrong checklist, because that's how you stay sane in a market that loves drama. If silver loses $90 and then spends days under it without snapping back, that's one warning sign. Not a doom signal, but a momentum-cooled signal. If physical premiums around you suddenly collapse while spot is flat, that's another. It would mean product is sitting and the urgency eased. If paper volume dries up while price fades, that would suggest the speculative heat is leaving. And if the gold to silver ratio starts ripping higher again while silver can't reclaim key levels, that would tell you gold is becoming the safer bid and silver is losing leadership. That's the checklist. Until those things show up together, I treat these slams as tactics, not destiny. Now, for those of you who follow miners, pay attention. Metals moving is one thing, miners responding is another. When miners finally wake up, they can move faster than the metals themselves because they're leveraged to price. But they also lag until the market believes the move is real. If next week holds strong closes again, miners could be the catch-up trade that surprises everyone who ignored them. And this is where I need your help again. If you're successful, whether you built a stack, built a business, landed a better job, or simply got your finances under control, share it below. Your story might be the push someone else needs to stop doom scrolling and start building. Also, reminder, the members-only recap is already out by the time you're seeing this. If you want the full rundown with extra context, join membership and watch it. That's where we go deeper, and it's how I can tell who's genuinely following, not just passing through. All right, final cliffhanger. If we open next session and silver gaps higher while premiums stay tight, the next target won't be debated in cents. It'll be debated in dollars. And the people who mocked $90 will suddenly pretend they always saw it coming. Don't be the person who waits for permission from the same headlines that always show up late. So hit subscribe because you're going to want the next update fast. And if you want the fastest alerts, don't rely on notifications. They're late. Join the WhatsApp channel in the description and you'll see the charts, the key levels, and the quick voice notes the moment something breaks. One message can save you a week of confusion. Stay plugged in, stay calm, and stay prepared. It's there for you, always. Drop OG John AG in the comments if you support original content over recycled clips. And answer these two questions for me so I can see where the community stands. Are premiums rising where you are? And if the gold to silver ratio keeps dropping, would you swap anything? See you next time.